Welcome to Financial Fitness Program. My name is Samir Bapat, and today we are going to learn three things. First is financial fitness self-assessment. Second is emotional money and investment money. Instruments available in the stock market for wealth creation. Those who were in the last webinar on Friday, how many of you have filled the self-assessment form for about your expenditures and all? So let me take you to that sheet. So I have put some colors in this, but the sheet is what I had shared last time. So those who have filled this sheet, were you able to identify that you are able to save 15% of your take-home salary? Okay, great. So the objective of all the exercise was that we have to identify whether we are saving at least 15% of our take-home salary, monthly take-home salary or not. So if we are not saving, then we have to work around with things or expenditures which are unnecessary right now, and start saving that 15% for wealth creation for our retirement. Now coming to today's subject, right? I have highlighted these things with green, especially these three items here. So my question to you all is, can we tell our kids that this year, since I invested the money what I was supposed to pay to for your fees, I have lost it in stock market, so I cannot pay your fees this year, and this year don't go to school. Can we do that? No, right? So this is some money which we cannot lose in stock market. We cannot afford to risk in stock market for devaluation. We cannot see it going down by 20%. We cannot tell to the school that I lost 20%, but you agree with 80,000 this year. We cannot do that, right? You agree with me? Yeah, okay. I thought people can negotiate with the school because no one answered.
Yeah, actually, I sent a mail to school.
Oh, really?
Yeah. April 4th is the last day to pay the fee. They have
Huh.
not responded yet.
Okay. So maybe you can negotiate with them, but more or less schools don't negotiate with that fees. So such kind of expenditures like transportation, whoever is doing transportation, he will not negotiate. Then third is, if you are preparing to send your son or daughter to some particular college, and you know that today's fees is let's say 7 to 8 lakh rupees. Putting inflation, by the time your son or daughter reaches, it will become X amount. So you start collecting some money for that education. That is also part of emotional money. Your son or daughter may get admission at a lower fees, but still you start preparing for that. So these are all emotional money. Again, these are something which we have to do, like most people do. We do insurance for ourselves, for spouse. Then if we are having our own home, then we have to pay property tax from which we cannot escape. So whatever I have highlighted, these are mandatory expenditures which we have to do, and mostly this expenditure comes once in a year and during lifetime, once in a lifetime. So these are the emotional money which we have to spend. These are one time expenditures, and we have to provision for it. We cannot lose that money because of our investment or because of market conditions. So that's why I call this money as emotional money. Everyone good with this definition of emotional money? Yeah? Okay, thank you. Second level of emotional money is insurance for vehicle, home, medical expenses, because these are not consistent, that may or may not happen, but still we sort of provision for those things. or we have a vehicle maintenance which we may do or may not do, but once in a year we have to take our vehicle. So this vehicle maintenance is also sort of mandatory thing. All of you have done a calculation and we have brought everything on a pro rata basis for this calculation here. After doing this calculation, we have something left out for the kitty. This part, I'll put some other color here, blue. Okay, so this, whichever money is left out after all the expenditures, is investment money. This we can put in little riskier instruments for getting higher returns, and we are not immediately dependent for this money. We can wait for the money to grow till our retirement or something big milestone comes in your life. So that is why I call this as a investment money. Everyone good with that? Any questions so far between emotional money and investment money?
So you means that 15% of money is good to for the retirement.
What I am saying is to start with, because many people don't even have 15% saving of their take home salary. So what I am saying is this is the minimum benchmark. If you want to plan for your retirement, you should at least start with your 15% money as a saving. The second point what we are going to cover is the instruments available in stock market for wealth creation. Now, we have various instruments for ensuring financial fitness. We have fixed deposits. So, how much is the return for fixed deposits? 4 to 6, 7%, right? And after tax, like let's say 6%, Kotak Mahindra says 6%. So, after tax, how much will be left? 4%.
Less than yeah,
4%. So let's say 4 to 6%. Then we have PF, which is 8.5%. Then again, we have a limit of withdrawal. We cannot withdraw it before 7 years. If I can wait for 7 to 8 years and I'm happy with 8.5%, then I can go with PF. But otherwise, PF has a lock-in, which may or may not work out for in our favor. Then we have gilt mutual funds, which give 7 to 8%, 7 to 10%. In our subsequent webinars, I will cover starting from gilt mutual funds. I will cover one mutual funds in detail. Here I am just covering the names and what is the return. So gilt mutual funds will give 7 to 10%. Liquid mutual fund will give 7%. Debt mutual fund 8 to 10%. Now till this point, these three funds are considered to be safe: gilt, liquid and debt mutual fund. The safest is gilt mutual fund. Why? Because the mutual fund invests in government securities. So they buy the government bonds and they invest in government bonds. So unless until Government of India fails, we will get our money. So that is why it is the safest of all. We have liquid mutual funds which are in the money markets, and then it comes debt fund. I'll come in detail when we take each type of fund in subsequent webinars. So when we have emotional money, we will be investing in one of these funds. Fine. Then we have our investment money. So what are the instruments for investing our investment money where we want higher returns? First is balanced equity funds, where the mutual fund invests in equity and debt both. Then we have pure equity mutual funds. Then we have thematic equity mutual fund. Then sectoral equity fund. After this, you can choose to invest in stock market on your own. So that is also one of the options, going straight away buying the stocks of the companies and investing. And last is future and options, which I am taking the classes on the Saturday if you are attended. So that is future and options, where you have possibility of earning 100% on your capital and losing also 100% on your capital. Okay, good question. Because if you have, see, when you are doing equity investment on your own, and then like I have mentioned earlier, you should have four things. One is the trading technique, you should have risk management and money management in place. Then only you will be able to earn 50% consistently when you are going uh, in equity on your own. If you don't have risk management and money management in place, then the loss can be more than 15%. But if you have a proper risk management and money management in place, it is very difficult to lose more than 15% because you will have your exit criteria, and that's why I have kept it 15%. We have a question from Chandra. So until number 5, we cannot lose money, right? No, we can still lose money in number 5. Debt mutual funds, even 4 we can lose. Up till number 3, we cannot lose money. It may not grow, but we cannot lose the money, our capital at least. From 4 and 5, it is dependent on the money market, and it is kind of lending the money to the company. But if we go and invest in a liquid fund or debt fund which has not given money or given the money to a right company, then there is a possibility that our money may reduce, but still the impact is very less. It's unlike stock market. Stock market falls 30% and more, but item 4 and 5 will not fall so much. Maybe 3 to 4%, 5% decrease will be there, not more than that. So what we should do, how we should be going about our investments? Wherever I have marked this emotional money, let's take example of we give the tuition fees to the school. Now we may give 1 lakh rupees in April. Now from this April till next April, what do? We provision that in our monthly expenditure. What we do is every month when our salary comes, let's say if we are paying 60,000, I'm taking 60,000 for better calculation sake. So 5,000 per month we have to pay for the tuition. So every time the salary comes, we pick up that 5,000 and put in a gilt fund or debt fund or a liquid fund. So what happens is from this April till next April, we every month we have that 5,000. That 5,000 starts earning money. By the time it's time to pay the fees, we will already have that corpus plus some additional income, which is better than FD, because FD we cannot break. If we break, they have penalty on that. But liquid debt or gilt funds, they don't have penalty if we withdraw the money. So emotional money we have to keep like that. Similarly, when it comes to insurance, anything which we have to pay lump sum in a year and comes under emotional money, even vehicle maintenance, property, everything, just divide it by 12 and streamline your investment. As soon as it comes, let it go in either of the 3 funds. So you already create the corpus. As and when the time comes, you can always easily take it out and pay the things. Why I am suggesting this is, I have seen people normally if they have to pay 60,000 or 1 lakh, people will pay with credit card, and then the whole finances go for a toss. So next month they somehow manage to pay that credit card, then next month again they somehow manage to pay, then they convert it into EMI. Rather than that, if we streamline our finances, if we keep saving for each item in under gilt, liquid or debt fund, then we'll be ready and will not be having any turmoil in our finances because a huge sum payment, which is anyway going to come. A question asked by Pratik is, does gilt fund have a lock-in period? We can invest in open-ended gilt funds. So there are open-ended and closed-ended both. So we can invest in open-ended funds. Once we are done with our emotional money, which we should be parking in gilt, liquid or debt funds, then we can come to investment money, which is our 15% saving every month. And this is where we should be investing in different mutual funds for the growth. The last topic what we are going to cover today is these are the equipments for ensuring financial fitness. So everyone who is going for investment must be having these three things. One is you should have a trading or demat account, a savings account, trading account, demat account from which you can buy your mutual funds. I don't advise going directly on the websites and buying. It may cost little less, maybe 0.5% or so. But then again, keeping the records becomes difficult. There are a lot of apps which are coming. They give option to buy from them and all. I am little bit not very comfortable with this fly-by-night apps and platform providers. So it is better to go with the established players like ICICI Bank, HDFC, Kotak, SBI, who are there for long time. So if we are buying something for our emotional requirements, it is better to buy from these people. For short term, you can go with low brokerage firms. That is not a problem. One more best part of investing in gilt fund or debt fund or liquid fund is, let's say if your savings account is in Yes Bank, tomorrow Yes Bank says okay, there is a limit to withdrawing money and you need the money. What do? You go to the demat account, you give an application, okay, connect my demat account to some other savings account, connect it to that savings account, redeem and withdraw your money from other account. But if you are going for FD, your FD is stuck in that bank, there is some RBI regulation that you cannot withdraw more than 50,000, you are stuck. So always going for emotional money in FD is not a good idea with given circumstances. It is always better to go with a demat and these types of funds where you can switch the saving account to some other bank. So that brings us to end of this session.